Good morning, this is Jason Sen from daytradeideas.com. It's the 16th of December. I'm going to run through some weekly charts of some currencies because they look quite interesting at the moment. This is pound versus the dollar cable. This goes actually back to 07. I've scrunched it right up to show you how we collapsed from 07 through to 09. There's an important Fibonacci resistance level at 164.25, and if I open this chart up a little bit, you'll see that we've been poking through that level over the last 2 weeks, spiking up but closing way below it, not managing to sustain any sort of break through it. There's also a slightly shorter term trend line, although when I say shorter term it goes back to May 2012, so still a good 18-month long trend line, so it is very significant. So what I'm trying to say is there's a lot of resistance here. We're spiking to test it and then closing way below, so we're giving it a big rejection over the last 2 weeks, and I think that signals a potential end to the rally that we've seen through recent months. It's not really a double top you're seeing here, but these, I think you call these tweezers tops, where you get these spikes up and lower closes. So all in all, I think it's creating quite a negative outlook in cable, and I would be wary of a sell-off. We can throw some fibs on here to try and look at some targets on the downside if this does start to sell off over the next couple of weeks. 160.75 is an obvious one. That would probably be the first target over the next few weeks if we do start to sell off into January. This is a weekly chart of the euro versus the dollar. Again, very important weekly Fibonacci resistance level at 138.33. Well, we've got pretty close. Well, earlier on in 2013 we got to 138.32, so that was bang on, and you saw we sold off quite significantly from there. And we managed to crawl our way back, and we got to 138.10, so we got to within 20 pips of that level, and we've rejected it last week. Spiked higher again. Not quite as negative candle as we saw on the cable chart, but still not too positive either. So again, we've got to be careful here. Not only are we hitting Fibonacci resistance going back to the 2011 to the year of 2011 when we saw that sharp sell-off, but we're also potentially looking at a double top formation after yesterday's rejection at 138.10. So again, looking slightly worried about this one, and we could certainly start to head lower. We've got a little bit of a trend line here, so I think that comes in at 137.30 area this week. Close below 137.30 this week would help to confirm that. We're going to have a look at the dollar yen. Weekly chart of the dollar yen here. Again, a potential double top. We rallied nicely throughout recent months, right up to 103.73 at the end of May. We sold off, and we've spent the rest of the time just gradually climbing up with a recent burst higher. We got to 103.92, so we did get through 103.73, but on Friday we got to 103.92, but we rejected that very swiftly, sold off quite aggressively, in fact, which was something we did expect, in fact, because we were looking for that double top. And the weekly candle yesterday wasn't very positive at all. The weekly candle last week, I should say, wasn't very positive at all, and there is a significant risk that we've seen a double top there, and that would be quite negative into the end of the year and the beginning of next year. So just be careful. It's obviously only a close through 104.00 that you'd start to feel positive again about the dollar yen. That's it for the look at the currencies this morning. We'll have a look maybe later on in the week. I'm Jason Sen from daytradeideas.com.